in times of increased uncertainties. This webinar is part of the side events program of the 2023 IDB annual meeting that is held in Jeddah, Kingdom of Saudi Arabia, under the main theme this year, partnership to fend off crises. My special thanks also and gratitude to the panelists and audience for allocating time to participate actively in this webinar. Also, our appreciation and thanks to IDB management and all the colleagues for supporting the inclusion of this webinar in the official program, as well as all the logistical support to help basically the speakers connect in this webinar. This theme is very much important from many dimensions. IDB is a multilateral development institution and is also a main institutional investor among many others, such as sovereign wealth funds, pension funds, endowments, insurance companies, and global asset managers who are key participants in the financial market. As we all witnessed for the last 5 years, the market went through various disruptions. To list a few of these, first we went through COVID and lockdowns, multiples actually of them that has happened during the course of a good 3 years, and their impact on the supply chain that disrupted mainly various sectors, whether it's health or food or industry or travel. So all the sectors got impacted, followed by a high inflation period that the global markets had to deal with. Then geopolitical tension and wars in different parts of the world that have also impacted the market and triggered various types of volatilities and reaction within the market. Also recently, there is an increasing debate and I would say interaction and news about de-dollarization and also the challenge dominance of the dollar as a currency of the world. Also, there are more and more talks about energy transition. So all of these disruptions impacted the investment portfolios and strategy in so many ways. In this context, basically, what will set the tone for our webinar today, and we aim to discuss basically 3 main, I would say, questions. How institutional investors dealt with these disruptions? How do they manage investment in times of uncertainties? And how global asset managers helped the institutional investors to manage this increased volatility with a special focus on OCIO solutions and private equity. Next. During their interventions, our distinguished expert panelists will elaborate further on these 4 themes. We picked really a mixture of panelists from global asset managers as well as from global and regional private equity players, as well as expert and managers from IDB to cover these 4 thematic from different perspectives. So first, we will talk about the impact of inflation and foreign exchange, interest rates hikes on the institutional investor portfolios and strategies in the capital market. Also, the increased interest in the outsourced chief investment officer solution and how these solutions can assist institutional investors in such volatile and difficult times. The third question would be how private equity managers of the emerging markets mitigate risk of inflation and foreign exchange to the US denominated investors. And then we will conclude on how can partnership between institutional investors and asset manager promote impact and contribute to SDGs. We have about 90 minutes, including our Q&A. So if you have any questions, please post it in the Q&A session. At any point of time during the webinar, we'll collect these questions. And when we start the Q&A question towards the end, we will address these with the assistance of the panelists. Next. To start, basically, let me start with David Ray, who's an MD with Russell Investments. He will be covering three questions. How far does the Fed need inflation to fall to stop interest rate hiking? The second question, how are institutional investors rotating their portfolio to deal with higher interest rates and sustained inflation? And the third, to conclude, in such volatile times, we have seen investors challenged with the active management required to navigate through these periods. How do OCIO provide outsourced solution, help investor in such period? So David, floor is yours.
Thank you very much, and it's a pleasure to join this session and to join the panel. So thank you for the introduction, and as described, the place that we would like to start is with the Federal Reserve and the challenges that they face. And so what we've witnessed has been really the most aggressive policy tightening since the early 1980s. And yet we still see strong payroll averaging above 407,000 for the first part of this year, and consumer spending growth remains somewhat unfazed. So it's a very, very challenging time for the Federal Reserve and for central banks generally to think about how they go about managing towards a soft landing, if that's what we require, a reduction in inflation, but without triggering a recession both in the US and globally. And the biggest challenge around that, and Milton Friedman said it well, is that monetary conditions affect economic conditions only after a lag, and that lag is both long and variable. So as is always the case, central banks and the Federal Reserve in particular are having to make these decisions without knowing exactly what impact this is likely to have or when the impact will be felt by the wider economy. The specifics around the question is when do we think that the Federal Reserve will stop raising rates and ease off? And the big barometer for us is looking into the labour market and trying to understand when the labour market is showing signs that it has cooled enough, that wage inflation is low enough to actually enable the Federal Reserve to hit its CPI, its consumer price inflation target of 2%. And if we look at the conditions now, most wage inflation measures are running at 5 or 6%. And I think the Federal Reserve would need to see that figure probably nearer 4% before it made a change to the to its policy approach and to begin an easing of the policy. And of course, when we look at unemployment, it's at its lowest since its 1960s. In February, I think it was about 3.5%. So, you know, what the Fed is facing is that daunting task of actually trying to control wage inflation without triggering a big spike up in unemployment, and doing that always, as I said earlier, always doing that in the context of a lag, an uncertain lag at that. So that environment has changed. We had a long period where really both monetary policy and fiscal policy were reasonably synchronized globally. And that allowed investors to manage their portfolios and generate returns on an ongoing basis. And you've already mentioned as chair some of the challenges that have been faced, whether that's geopolitical, whether it's obviously the impact of COVID and the policy measures that government made. And those things began to make the challenge of managing assets more complicated for for institutional investors and for asset owners thinking about how to position their portfolios. And what we've seen more recently is really trying to think through how best to position portfolios, to rotate portfolios, while always watching the central banks and the decision makers within central banks and the impact that that may have on economic conditions, economic fundamentals, as well as managing portfolios through a lot of uncertainty, whether that's geopolitical uncertainty, whether it's actually longer term structural uncertainty in terms of population growth and demographics and some long-term trends and themes that come through that. Thinking specifically about a number of asset classes, we see limited upside in most equity markets, just given that backdrop of the potential recession. So what that means is recognizing that we're not going to see a significant repricing upwards of equities. When we look at equity markets, we do try to assess them through a cyclical lens. So how do we think the market cycle and the economic cycle will evolve? And we talked a little bit about the policy challenge that drive the market cycle. Another key determinant is what impact that has on earnings and earning growth for individual organizations, both on a company perspective, a sector perspective, and a regional perspective. And then we look at the valuation of different asset classes, both relative to history and relative to each other. And so when we look at equities, we do see some valuation benefits for non-US equities, so particularly across Europe. But outside of the US, equity valuations provide more support, if you like, than US equities. Emerging markets, really any improvement there is tied to the US dollar, and you've already mentioned the challenges that the US dollar is facing there. So we may see some uptick there. And Europe, the big expectations for Europe was a challenging winter, given the events on the borders of Europe and given the impact on energy prices and the availability of energy within Europe. Actually, Europe weathered the winter better than expected, partly due to those weather conditions, but also some of the policy measures that were taken, and so that has allowed a bit more support for European equities. Another area of key interest, and it's an interesting challenge for asset owners, is thinking about real assets, so things like real estate, infrastructure, and other similar sort of asset classes. The challenge, the higher interest rates and what that does to valuations. However, the plus side of a number of those asset classes is the contractual inflation linkage. And so if you can own assets that provide an income stream that is tied contractually to inflation, that's attractive in this sort of environment where we have sustained inflation pressure. Another couple of areas to talk about when we think about how investors are moving their portfolios around. One is thinking about private markets, and I know other experts will talk in more detail on this later, but some of the things that we're witnessing there is actually more of a rotation within private market investments. So a number of investors through the course of 2022 were challenged by what's sometimes called the denominator effect. So where they had private market allocations, they became more significant within the portfolio. And some of these investors are looking for opportunities through the secondary market to realize and to sell some of those private market investments. That provides a great opportunity for investors with capital that are looking to deploy it into private markets through that secondary market. So we see some interesting opportunities coming through there. As always, it's about looking for opportunities that have high quality earnings, that are high quality companies with resilient earnings and cash flows that can withstand some of the inflationary pressure. So that might be organizations with strong competitive advantages. And the final area just to touch on when we think about how institutional investors are rotating and changing their portfolios are really some of those longer term themes, and the big ones being ESG, so environmental, social, governance issues. Investors paying more heed to that within their portfolio and thinking and looking for opportunities in that landscape. And in many cases also looking for ways in which they can have an impact with the assets that they own and that they deploy. And so looking potentially beyond just pure ESG, but thinking about how they can use their assets to deploy into to have a real impact on economies and on individuals around the world. So yes, lots and lots of things moving there. Certainly rotation towards private markets in a very bespoke and thematic fashion, and thinking about those investments that have contractual inflation. So maybe that's things like in infrastructure with contractual inflation linkage, and potentially, you know, things like renewable energy and other investment opportunities. The final question I wanted to touch on was really the role and the growth and interest in the idea of the outsourced CIO, outsourced Chief Investment Officer model. And really what that is responding to is really the challenges that investors face in the current environment. So we've talked about markets being more volatile. The opportunity to generate returns from investments is more challenging. And that environment means that there are a lot of, frankly, a lot of moving parts within the portfolio that need to be analysed, need to be considered, and changes that need to be made. So when we look at those outsourced CIO solutions, we see them offering a number of opportunities to asset owners. The first one is just the breadth of asset classes that can be accessed. So really through that approach, investors can get access to a whole range of different asset classes, different investment strategies across the globe. And that provides a real benefit in terms of risk management. So a very traditional diversification can be achieved in a very precise fashion by allocating across a large number of asset classes, but also different investment strategies. And I think it's those investment strategies, those different strategies, and the way they can be deployed that is very powerful in this sort of environment. So I talked about the fact that we have this synchronized monetary and fiscal policy and lots of markets generally performing well in a synchronized fashion. What we see now in a more volatile environment is actually a greater opportunity for active management, for those decisions, those investors that are able to assess individual companies, assess regions, assess sectors, and make decisions based on the fundamentals of each of those different investments. So we think it's a good opportunity for active management, and that approach of OCIO allows access to different investment strategies in a very efficient and very cost-effective fashion. The final couple of things to touch on, again, on that theme of risk management, you can diversify, you can also be more dynamic across the portfolio. So you can respond to some of the emerging changes, whether that's the evolution of monetary policy, or whether it's events outside of the economic sphere, whether that's geopolitical or other events. So you can manage the portfolio with a higher degree of dynamism. And then finally, it's really just touching on those themes, and I know again they will be covered later in the session, but those ideas of ESG and impact, and being able to embed that within the OCIO mandate or solution. So the way we see that and the way we perceive that is it allows for a very bespoke portfolio that is really tailored to the needs and the requirements of the individual investor. And those needs and requirements can change, and the preferences can change, and that can all be captured through the OCIO solution in a very efficient and effective way. So I'm going to conclude there, but happy to address any questions that may come up through the session.
Thank you, David. Very interesting and enlightening. Perhaps maybe just to sum up a few takeaway points from your intervention. Basically, you mentioned about the reaction of various central banks and policymakers to ensure soft landing, basically in dealing with these disruption. Also, another point is timing of the various actions is of essence. As well, you touched on the impact of various asset classes and how they're behaving in the market in reaction to these disruptions in the market. You also elaborated on the benefits of the OCIO solutions basically that offers to access a whole range of asset classes. So it's a wide spectrum of asset classes that institutional investors can tap into, as well as various and multiple strategies. So it offers an inherent diversification basically in the portfolio, and that is key. Also, it offers a proactive management in dealing, especially with high movement in the market, to really make sure that the right rebalancing and the right actions are taken in a timely manner. And to conclude, basically, it offers a bespoke solution where we can embed the ESG dimension or any other, I would say, specificities of any of the institutional investors. Let me now move. Basically, we heard from a global asset manager perspective. Let me move now from an institutional investor perspective. Baulam Hammouni, Manager of External Fund Management, will address three key questions. The first is, what are the main drivers of the investment portfolio return, and how can asset manager help in achieving investment return? Second question, from an asset owner, execution of the investment strategy is crucial to achieve the long-term investment objective. As it was mentioned by David earlier, this can help in various ways. But what are the main building blocks for a successful execution of such solution? And to conclude, how private asset classes are positioned within an institutional investment portfolio. Baulam, the floor is yours.
Thank you very much, Hadi. It's a pleasure to be here in this webinar and share the perspective of an asset owner and an institutional investor. I think David has touched upon the macroeconomic, mentioned a lot of risks associated with investments. Talking about market cycle, economic cycles, and throughout the time, definitely investment portfolios are exposed to different risks. The title of the webinar is Institutional Investment in Times of Uncertainty. So what we know, what is certain for sure, is that there is always uncertainty in the market. But this is something that we need really to factor as an investor, as an institutional investor. If we just go through the last 30 years or 40 years, we've been through different crises, whether a tech bubble, global financial crisis, Asian crisis, the Black Monday. If you can summarize most of the crises, or for equity specifically, as we know, there is bear markets, bull markets. We've experienced 12 bull markets, and with a median duration of 2 years. At the same time, we experienced 12 bear markets, and with the median duration of 12 months. The median return for the bull market was 59%, and the median return for the bear market was minus 26%. And basically, the worst for the bear market was the 2008 global financial crisis that basically returned minus 52%. We experienced also a bear market in the COVID in 2020, and the return was about minus 34%. But at the same time, the bull market's return, the longest one was ended in 1988 and returned 162%. And the last also bull market ended in December 2021 with a return of 98%. And then in 2022 was very unprecedented time, talking about all the market policy tightening, the geopolitical events like the Ukraine-Russian war, etc. So what should be the behavior of institutional investor? The main important questions is the objective of the investor. There will be always a risk. So the first question that we need to answer is the objective, and whether be it a pension fund whether it is a defined benefit, contribute benefit plan, or an endowment fund or multilateral. All these institutional investors, their main objective is to boost their return. And of course, they have spending requirements, they have liquidity that they need to manage. The time horizon is generally on the long run. And what happens usually is basically we go through a strategic asset allocation. And this is the main driver of most of the institutional investment portfolio. To address the first question is basically 90%, depending on the empirical evidence, talking about 80 to 90%, the strategic asset allocation is basically drive the performance of the institutional investor. It is on the long run, definitely. And of course, this is something that is very important. Number two, as a driver of the institutional investor, is the dynamic allocation that will explain the part of the marginal, the remaining over 100%. And this is basically can be a high or low out of the range of the asset classes. And then the third driver will be the tactical allocation, and this basically is done through the active management. And this is where you can exploit short-term opportunities through deviation from your strategic asset allocation. Yes, we need to have a strategic asset allocation on the long run that will drive the return. But as I mentioned by David, and also as we know from the market, there will be some dislocation in the market in the short run. Like in 2022, the first quarter, there will be dislocation in the market, and then fixed income by the second half would be like a more appealing asset class. While before 2022, the fixed income was representing a low yield environment, and most of the institutional investors were looking more to equity. So the tactical allocation with the fund manager will help basically go through this and then explore the short-term opportunities. But then how to do it? And this is, we'll try to address the second question, the execution. Of course, execution, when talking about execution, it starts also from the planning. And then what David talked about OCIO, OCIO can go from a full outsourcing the investment activities to a professional investment professional or investment firms such as Russell or others, or you can do it in-house. But most of the asset owners or institutional investors, they have to do it in a hybrid manner. In IDB, we've been for a long time a direct investor. We helped many member countries to investing in different sectors, regions, and it has been very successful in terms of ESG impact and development. But at the same time, we do have our constraint in terms of long-term investment return, and also in terms of spending, etc. And then we move to working more with external fund managers, and then by asset class. Well, we can have an in-source for the sukuk or for the fixed income, but there are certain asset classes where you need access to experienced fund managers. And then when you talk about the way I will define working with external fund managers, and if I specifically focus on OCIO, there are three levels. The first level will be the multi-asset, and here by multi-asset, I mean the investment strategies. And then here, clearly, we need to know the different factors that I mentioned, all combined together with using long-term capital market assumption to define the strategy that meets the profile of the investor. Number two, liquidity. Number three, in terms of risk, the time horizon. This is very important. The second level will be the multi-style. The multi-style, because when you build your portfolio, particularly when you talk about equity, you have different style, growth, value, momentum, and it is important also to have kind of diversification. And then diversification of the style also, it's important in the strategic asset allocation. So diversification will come at different levels. So the multi-style is important in terms of diversification, so it's important to have different style. The third level will be on the multi-managers. So it's important to know that the execution also relies on the quality of the fund manager. So there are different aspects how to assess the fund manager, whether it is team, process, product, performance. When you gather all of that, then at the end of the day, you need to find the right fund manager. A good fund manager can be good in certain strategy, may not be good in other strategy, and can be in one region, not good in the other region. So a multi-manager is important. So what do we need? We need access to risk. We need to have a breadth. That's what David has mentioned. We need also a process. What, for example, OCIO such as Russell present is an open architecture. There are systems, and it basically help the institutional investors to execute in a fast manner. And then number two, to react dynamically and tactically to any event in consultation with the asset owner, obviously. And then, of course, the monitoring and the reporting. This is also important. This is where you need, for example, to stop or terminate the fund manager or go to another one. And this is, in a nutshell, when it comes to executing the strategy. So it starts with, as I said, from the planning, then the start, then the manager, and if you notice, diversifications come in all what I say. So you never diversify enough. There's one basically anecdote or story happened when one retiree basically invested all his money in Enron, which was very hot stock at that time. And then because of the scandal, no one expected the Enron would collapse. He lost all his retirement. So it's always good to have diversification at the level of asset allocation, diversification at the level of portfolio construction, diversification at the level of fund management, and then to work with the best in class, whether in terms of process, people, and of course, monitoring. Now, as an institutional investor, from our perspective, of IDB or I think other pension funds, when it comes to equities, we usually go to public and there's volatility. But in the same time, what about private markets? How do we position private markets? Because of diversification, having just a public equity fixed income kind of portfolio, it doesn't help a lot. We need always to explore new investment opportunities that are decorrelated with the existing asset classes. And private market, for a long time, and empirical evidence has shown that has outperformed the public equities. Sometimes from 380 basis points, sometimes 480 basis points, depending on the region, depending on the sector. But what is important here is basically to make sure that you are selecting the right fund manager. The difference between the top performance for public equities and the worst performance are really very narrow. But when it comes to private markets, it's really huge. And I think Shahir and other colleagues will talk about it. It's important really to make sure that you are getting into the right private equity fund manager, because there is a lockup period, there's a liquidity premium. And when you make a decision, it's always very difficult to go back, although there are secondaries as mentioned by David, but that's not always easy. So private markets here, you have different things. You have private equity, you have real estate, you have infrastructure. Some of them can be a growth booster because we are a long-term investor, and then can boost the return over the next 10 years. Most of the private equity are 10 years. And then others can be diversifiers. Basically, you add diversification layer to your portfolio, such as private credit, etc. And then there are inflation hedge. And then we talk about real estate, infrastructure, and basically this helps in terms of inflation like these times. If you invest in real estate or infrastructure linked to the inflation, basically give you a good stream and can manage, mitigate to a certain extent the risk of inflation. So in a nutshell, I would say private markets are important. They are part of the landscape, but most important is really to work with the best fund manager and to have a clear diversification even within the private markets. And we don't put all our eggs in one basket.
Thank you, Balam. Before I move to the following panelist, I will just summarize a few takeaway points from the intervention of Balam. Basically, he agrees with David that various external factors impacted the portfolios, and he highlighted the fact that uncertainty actually has been always present at all times, and he touched on various occasions and how the markets reacted during those cycles. He concludes that there is always a risk, but from an institutional investor perspective, there are certain key drivers that should very much be there to manage a portfolio. First is the objective, which is key and should be captured in the strategic asset allocation. And this tends to be a long term, so that one doesn't panic as soon as there is volatility here and there. Also, dynamic allocation is very key, as well as tactical allocation, to ensure that one is achieving the desired return. Also, he highlighted the importance of execution and elaborated further on the OCIO model that was tackled by David. And here he explains that there are three models basically tackling three levels: multi-asset, multi-style, and multi-manager. This, of course, offers, I would say, a good approach for institutional investors to tap into expertise of established global asset managers to manage basically their allocation. And then he concluded with the importance of diversification, and especially towards private market, to ensure that the portfolio meets its return objective over time. So let's continue really with the perspective of institutional investors, but this time from a different angle, PE angle. And Shahir, Senior Fund Management Specialist, will tackle three questions. First, given the importance of private market in a diversified institutional investment portfolio, what are the main building blocks of a private investment program? What are the main successful private program attributes? And finally, what are the main challenges that an institutional investor may face in implementing a private investment program? Shahir, floor is yours.
Thank you very much, Hadi, and it's a pleasure to take part of this webinar. Indeed, Hadi, and as mentioned by Balam earlier, private investments are, in particular the private equity, are of extreme importance to diversify the portfolio through investing in uncorrelated asset classes, and that helps also to boost the returns of the portfolio through the liquidity premium and the targeted usual double-digit returns. However, to build an investment program, a private investment program, certain building blocks need to be put in place, which are intercorrelated and interactive. First one would be setting the objectives and planning. So as there is no correct allocation to private equity or to private assets in general, as this will depend on the return and return objectives, risk budget, and return requirements of the source of funds being used, whether it's an endowment, whether it's a defined benefit pension plan or defined contribution pension plan. The second building block will be the manager selection and due diligence, and this is of an extreme importance given the large gap that we see in the market in the returns of the top quartile managers and the lower quartiles, where returns are varying from high double digits to extreme lower returns. And then once that is done, actually we move to the portfolio development and deploying the strategies, the pre-agreed strategies in close coordination with the GP or with the selected fund managers. And once that's done, we move to the fourth building block on the monitoring the investment and overseeing the exit phase, which take us to the last building block to refine the strategy based on the lessons learned move to the replanning and resetting the objectives. However, so this takes me actually to the second questions, which are about the attributes of a successful private investment program, which can be summarized on having a consistent investment strategy with infrequent tactical allocation to opportunistic categories. Then it's important also to set a high hurdle rate or hurdle for the investment, but that is still achievable. Also, it's important to have a streamlined, efficient, and flexible investment process at the institutional level. Diversification, as highlighted in Sirs by Mu'alam, is very important, whether that's by geography or by vintage or by manager. So that's something that helps mitigating further within the risk within that asset class. Six, the investment decisions, the disciplined investment decisions, which are based on long-term track record and on organization strength, are important to ensure the success of the investment program, of the private investment program. Also, the alignment of interest between the general partner and the limited partners is of an extreme importance, to ensure that the strategies put in place are aligned between the two stakeholders. And last and not least, the patience in the performance evaluation, given that it is a long-term investment. So I would conclude with the third question, which are the limits or the challenges that are faced under the private investments program. First of all, the limited transparency compared to listed markets. Also, the illiquidity or the lockup, as these funds are usually 10 years plus. So once we are committed, it's difficult to reverse in the strategy. Also, the private equity investments are relatively expensive if we take into consideration the management fee, the performance fee, the various organizational and operational fee. It's kind of relatively expensive investment. Also, from the J-curve perspective and the deferred returns, that's one of the challenges. Challenge that we are facing and that we need to explain to our fiduciaries and to our boards, as the performance need to. It's a long-term investment, so we need more time to assess the performance. Fifth, also such investments require significant amount of time, effort, and resources to come up with the top quartile fund managers and deploy the strategy required. Also, I mean, last piece would mention also the difficulty to rebalance in an efficient and timely manner, given the nature of the underlying and of the funds. So I will stop here, and if there will be any questions during the Q&A, we'll be happy to address it. Thank you very much.
Thank you, Shahir, for this interesting intervention. Basically, to sum up, you covered three, I would say, dimensions. First, I mean, the key building blocks for a successful private investment program. And these are setting an objective and a plan, the manager selection and the due diligence, the portfolio development and deployment, monitoring the investment and the exit process, and refining the strategy by taking the lesson learned from the said investment. Also, you tackled quite few success factors that needs to be there to ensure the success of such a private investment program. First, setting a high hurdle rate, and this should be as a benchmark. Also, to have a streamlined investment process, as well as a diversification, and having a disciplined investment decision-making process, as well as an alignment of interest between the GP and the LPs, and also to have patience in evaluating the performance of private equity investment given the long-term nature of such investment. Also, you concluded with some of the challenges that are faced in private equity investment programs, the limited transparency versus the listed equity, given the illiquid nature of the investment itself. Also, fees tends to be higher than managing a listed equity portfolio, given the effort that is put by the GP in managing such portfolio. So these are just to enumerate a few of the challenges that an institutional investor would face. So now let's move basically to hear from a regional PE fund manager in a region that got very much impacted by inflation and volatility, North Africa, to see how, as a regional fund manager, I tackled the three questions. So Nabil Treki is managing partner and CEO of SPE Capital. He will cover three questions. First is, how is the global economic context impacting the North African macroeconomic situation in North Africa? In such a volatile environment, how can private equity assist in navigating through these challenges and serve as hedge against the inflation and foreign exchange volatility? And the third question, in terms of impact, how PE managers are assisting the DFIs in achieving their objectives in terms of ESG and SDGs. So Nabil, go ahead, the floor is yours.
Thank you, Hadi. It's a pleasure to participate in this webinar, and thank you to this Development Bank for the opportunity. Now, it is clear, as Hadi mentioned, that North Africa has been going through a very challenging period on a macroeconomic level, affected initially by COVID, then by post-COVID consequences and its impacts on the various parameters. The Russia-Ukraine war and its impacts on commodity prices and consequential inflation, and last but not least, structural public finance challenges in some of the countries of the region. Now, just a few basic numbers. If you look at North Africa, which goes from Morocco to Mauritania as a region, the GDP of the region was at 5.4%, grew at 9.4% in 2021. That decreased to 4.3% in 2022, and it's expected to remain stable in 2023, approximately at the same growth rate. It's been affected in 2022 by the contraction in Libya and the effects of the drought and agricultural output in Morocco. Now, if you look at the next couple of years, it is expected that, as I mentioned, that the GDP growth will remain stable at rates which are around where they are globally. However, the region's economies, which have always been affected by global shocks, regional shocks, remain subject to significant headwinds. Obviously, there's Libya and the situation in Libya. There's climate shocks where, I mean, we're seeing extensive droughts in in the Maghreb, especially from Morocco to Tunisia. And so that continues to put pressure on the region's economy. You have today Egypt and Tunisia, which are suffering from a significant public finance crisis, coupled with sharp pressures on their local currencies. I mean, you've seen, I'm sure, the devaluation of the Egyptian pound, which has gone from 16 pounds to the dollar early 2022 to just above 30 now, to an expected devaluation to probably 35 EGP to the dollar in the next few months. So we're talking about a currency which has more than halved in about a year. Last but not least, and this is important across the region, is we're seeing that the sharp increase in commodity prices, whether they be energy or food commodities, resulting from the global shocks or the global situation, have contributed to high inflation in the region, and especially high inflation in basic goods, whether it be transportation costs, food prices. As I'm sure you know, the region is a net importer, a clear net importer of products like wheat, and as a result, there's a lot of pressure on food prices, and that can have an impact on the social stability in the region. Now, all in all, not a great period for the region, but I think on the other hand, we're not in a part of the world which is structurally stable. If you look at North Africa as a region, it's been structurally fragile because it has gone through regional shocks like the Arab Spring early 2011. It's been affected by macro shocks, whether they be before that the global financial crisis, the political unrest, terrorism, and such shocks. So we are operating in a region that is structurally fragile. The good news is we know that, and we've adopted and adapted our strategy to that. So it's not like the shocks that the situation that we're living in today is a situation not dissimilar to what the region has lived through since 2010, for example. So whether it be if you look at us as a private equity manager and our approach, so moving to the second question, both our approach to investments and our strategy have taken the fact that we operate in a region that's structurally fragile into account. We know that we operate in a region that's affected by macro shocks, whether political and economic, and we've since for the last 10, 15 years adopted the way we invest, the sectors we invest in accordingly. As such, we today, if you look at where we invest as a private equity fund manager, we tend to only focus on sectors which are structurally resilient, which provide a natural hedge against FX devaluation. So we look at sectors like FMCG processing, food processing, pharmaceuticals, export-oriented sectors, and sectors which offer opportunities for import substitution. Now, these sectors fall into two categories: either sectors which grow faster than the GDP, faster than inflation, and therefore will, at the end of the day, deliver higher returns or sufficiently high returns for us as a fund manager, for funds and for LPs. Or we invest in sectors which provide a natural hedge against FX devaluation. So if you invest again in sectors which are, and you have companies in countries like Morocco, Algeria, Egypt, Tunisia, you have companies which serve mainly the European market or serve West Africa as a key market and therefore export. And in these companies, when you do have a devaluation, it actually improves the margins of the business because you sell in euros or in dollars and you produce in local currency. You also have sectors which offer opportunities for import substitution. Pharmaceuticals is a natural sector for that. So if you invest in companies which produce basic generic pharmaceutical products, so whenever there's devaluation, the cost of import goes up. Your raw material, part of them are imported, but part are produced locally. Your other costs are local, so you end up, one, taking a higher share of the market, and two, improving your margins. Finally, if you even go beyond sectors, we believe that even if you invest in the right sectors, in the right companies, you cannot. Growth of the companies only gets you part of the multiple of cash that you're targeting. So we target for any given investment a multiple of cash of 2.5 times to 3 times US dollars, and empirically in the. If you invest in a company, take a minority stake, even if it's a solid company, typically that's what you'll get because you get that growth. You get then downward pressure from, for example, factors like FX devaluation. So our approach is to invest mainly by taking controlling stakes in the companies we invest in. So we take control of the companies. We drive the growth, but in addition to growth, we action other levers that generate value and which get you from the 1.5 times to 2 times cash to the 2.5 to 3 times cash multiple that we target. And these are factors like deleveraging, operational improvements, etc., which, from our experience, you can only implement and attain in a 5-year period, which is our typical holding period, if you control a majority stake in the companies. So all in all on this question, again, we're conscious of the fact that our core region, which is North Africa, is a region which is structurally fragile to macro shocks. As a result, we've adapted accordingly our investment strategy. So we invest only in sectors which either grow faster than GDP, faster than inflation, and or provide a natural hedge against FX devaluation. So we'll grow faster with higher inflation and higher devaluation. And then second, in addition to the sector, we've over time shifted our investment strategy to mainly invest in companies where we can take controlling stakes, because we know that in such companies over the holding period, we can drive multiple levers for value creation, not only growth, which has been the traditional approach in North Africa, and specifically in Africa as a whole, but add to that value creation that can come from operational improvements, improving management, improving governance, and deleveraging. Now, finally, in terms of impact, we are fortunate that we invest in a part of the world and where by merely applying our own investment strategy, we have impact. So in every investment we make, we, by definition, improve governance, grow employment, improve workers' conditions, and positively affect the communities that are in the ecosystem of the companies we invest in. Now, since 2020, we decided to be more intentional about ESG and impact, to shift away from the traditional view, which was looking at ESG as a risk and looking at our role as mitigating that risk, but more from a perspective of considering the positive contributions that we can have in the areas of ESG and the impacts we can have. And being intentional means, as you invest, knowing exactly where you can help the companies in ESG and impact, and putting together a strategy to do that and monitoring the improvements. So back in 2020, in the midst of COVID, we benchmarked existing frameworks for ESG and impact globally. We found actually that most of the existing frameworks for ESG and impact were more suited for impact funds, which we are not. We're not an impact fund. We say that we invest with impact, but with a primary focus on delivering financial returns to our investors. So we decided to develop our own framework. We selected there's 17 or 18 SDGs that exist. We selected the 8 that are most consistent with our own investment strategy. We developed a framework around these 8 SDGs, and today that framework is embedded within our investment strategy, in a sense that Today, we look at ESG and impact exactly like we look at financial performance. So if you just look at typically when you invest in companies, you look at its financials when you're investing, you project your revenues, EBITDA, your multiple of cash and IRR at exit, and then every year you look at where you are and how you're performing versus those financial objectives. With SDG and with ESG and impact, we decided to do exactly the same thing. So initially, as we're doing due diligence on the companies, we assess the companies from an ESG and impact perspective. We identify what needs to be done to achieve improvements. We set a target for where we want them to be on these dimensions at the time we exit, and then we measure progress every year. And that, from experience over the last couple of years since we've implemented that, has simplified reporting to our LPs. So a lot of our LPs look at ESG and impact as an important factor today, an increasingly important factor for even choosing or selecting GPs to invest in. So it has improved reporting and it has simplified it, and it's something that we've totally integrated within our investment strategy today. I hope I've covered the 3 points. I'll be happy to take questions during the Q&A session, and I'll turn it back to Hadi. Thank you.
Thank you, Nabil, for these interesting insights. Just to sum up, I mean, you touched a bit on the macroeconomic situation of North Africa, and you have highlighted that as a region, it has also certain regional other, I would say, impact that impacted the market, Libya and some climate shocks like drought and others. Although the GDP was very much impacted downwards, but you remained very much still optimistic about the region, and also seeing certain opportunities for private equity investors to benefit from the market cycle itself. Also, you have elaborated on certain actions and strategy orientation on how you help institutional investors fight, I would say, and have a hedge against inflation and FX volatility, basically by investing in resilient sectors, whether these offering a natural hedge like export sectors, also targeting sectors that are likely to grow faster than inflation. So this is very much about, I would say, investment objective and sector, I would say, screening and opportunity generation. Also, in terms of action as well, you mentioned it's very much important to take control, to be able to drive the growth of the company and action various other levers to unlock value within the company and realize the targeted multiples at exit. Also, in terms of ESG and impact, it was mentioned that it's very much embedded in your investment strategy, and also during the course of the due diligence and identification of the companies, you tend to identify where you can help, and accordingly you devise a strategy and a dashboard on how you tackle this. So this takes us to our last speaker, but not least, a key PE player, to give us another perspective from another market, basically Turkey, that also got impacted by inflation and volatility. So Erman Kalkandalan, he's the CEO Turkey for Frankel Templeton. He will be addressing 3 questions: how the global economic context is impacting the macroeconomic situation in Turkey and what to expect. Also, in such a volatile environment, how can private equity assist in navigating through these challenges and serve as a hedge against inflation and FX volatility? And then he will conclude on how PE managers are assisting the DFIs in achieving their objectives in terms of ESG and SDG in Turkey. So, Erman, the floor is yours. Go ahead.
Thanks, Eddie. Can you hear me?
Yes, we can.
Okay, thanks for the chance. You guys are always the trend setting in, talking these things, and we are very thankful to IDB, supporting all the PE managers, and in this region you have a very key role, the growing this very key this capital formation. It's very weak in many of the countries that we operate. And this in DFIs like IDB has playing a very key role in developing this important channel of the private capital. I'm working for Templeton for 17 years. Franklin Templeton is one of the oldest asset managers in the region. In fact, in Turkey we have an office over 25 years. We are actually the only and the biggest international asset manager in the country now. As I said, I'm working here for 17 years. We have seen a lot of ups and downs in, the Turkish macro in the last, let's say, in 2 decades. The first decade was, between 2003 and 2013 was one of the best in terms of the performance of economy, inflows of, the private capital and the public capital. But since 2013, the economy has been more volatile, mainly actually since 2018, the pace of volatility increase, and it has been more challenging for a lot of asset managers, even the international ones or the local ones, to tackle some of the challenges. Despite actually the turmoil, interestingly, Turkish economy did well last year in some areas. The stock market was up to almost 200% in local currency, over 100% in hard currency. The real estate did phenomenally well, over 100%, despite inflation is 84%. Daily volume of Turkish stock market is around $6 billion. This is by far, if not the biggest stock market in the region. The Turkish stock market has always been very active, and I know that especially the Russian stock market is out of picture. So it's one of the most diversified and one of the active stock markets. The reason of these numbers is actually pretty simple, because the Turkish government made a choice of picking the growth and employment over inflation. So this is obviously taking a lot of tolls in the different parts of economy. The channels of financial intermediation is very clogged. The banking system is not clearly channeling enough capital or like borrowing to the companies. The loan, personal loans or mortgage or car loans are actually, it's very difficult to obtain. Inflation, as they say, is rampant. Official inflation is like last year was 84, but if you actually look at some other measures, the real inflation has been very painful, and with some measures it was almost like the 150%. Despite all these challenges, the economy grew 3% last year. So the international part is affecting the Turkish economy. It's first, initially after the pandemic, it really affected the Turkish economy on the commodity cycle. Turkey is an commodity importing country, and it's actually a big commodity importing and processing country, which then in return exports most of these commodities. But it's a big nation with 85 million people. It also consumes a lot of commodities, mainly energy on the metal part. Even now in the last 10 years, is also on the grain and the food side as well, despite Turkey used to be the food exporter, now is actually a food importer. So the high, the global markets, especially on the commodity cycle, affected the Turkish markets big time. Then in the last 1.5 years, the Fed cycle is affecting, like any other emerging markets, the Turkish economy through the higher cost of borrowing. The elections are 15 days ahead. I think the current economic model, basically picking growth and employment over, the inflation and basically current account deficits is just, I don't think it's sustainable. So in a couple of weeks' time, there will be elections. I think we expect, irrespective of the results of the election, I think that the policy will change in Turkey. We will see a more orthodox, more predictable economic policies in Turkey. That, one of the biggest problems, obviously, for everyone who comes into the country is that basically they don't know the currency level, which makes it very difficult to invest or even lend into the economy, because it's very difficult to assess the risk coming from the currency side. I think we might see another leg of devaluation, but then we will see more orthodox policies going forward, either with the new government or the current government. I think that's what we expect. Turkey is it's the most diversified economy in the region. It's a big exporter. It is one of the biggest consuming nations in the region. It has also plays a very important political role in many aspects. So I think we are expecting, as the team here in town, that a more basically open channel economy going forward, starting with the second half. Obviously, initially it will be painful. We can expect maybe a recession or a very high cost of borrowing. But I think this will be basically an important step to be a more orthodox, or more actually an economic model that the rest of the world and we can understand in a way. So how do we operate in a challenging environment like this? I think our operating model is we stay very close to our companies. We have two portfolios in Turkey, over $1 billion in assets, in private equity assets. Our local team, we have a dedicated value creation team as well, who tries to stay very close to companies. I think a couple of things we did is, in an inflationary environment, how you stay ahead of the game is basically you need to be very agile. In some cases, the products you sell, is the price is up 10%, or your cost of goods is up 20%. So if you are very slow in basically monitoring the market, understanding the dynamics, even reflecting into your prices, you lose margins. In some cases, you lose business. So agility is the most important thing. And in agility here comes through your management team, comes through your management information systems. Like if you cannot measure something, or like the data doesn't come from the field or the market to you, you basically cannot make a good decision. Supply chain management is key. If you now we feel a bit less, but if you remember, certain goods or like the transportation was a major issue after the pandemic. Now we feel less of this pain, but it's still there. We have a logistics company, actually, in one of the portfolios. This IDB is also a part of it. It took 2 years to get the trailers, the trucks to Turkey. So if you don't order them in time, once your clients just ask you to move a good from somewhere, you can say, oh, we don't have trucks to move them. So you're managing your supply chain from each part is becoming very key. I think we did well. The inflation is normally hurts, the consumer companies. We also have a couple of them in our portfolio. But in this period, actually, in the last couple of years, they actually expanded their margins. If you are both, they're actually listed counterparts in our companies, especially the ones that you will expect them to be hurt the most, the ones that facing the consumer, because in a high inflationary environment, the consumers are losing their purchasing power. And then that's when you struggle to sell, which was actually not the case. And many of almost all our companies expanded their margins. I think one of the things that the consumers do in a very high inflationary environment is they basically hoarding goods, not cash. If they have money, they buy, if they are like a very small consumer, they buy like basically maybe even garments or food. If they are more affluent consumers, they buy real estate, cars, stocks, whatever they can lend money. So in this environment, actually, our companies, which we would expect to be hurt the most, like, you know, the main B2C companies, actually, they came out very strong. The exporters, which we still continue to invest in this market, which actually benefited the most in the last 10-year cycle because the currency continued to depreciate, did very well until last year. This year, they struggled a bit because the currency was stable and when the local inflation was high. But we believe exporters will continue to do well. So overall, our companies did well. Overall, the companies in the economy did well. We see this from, you know, one of our portfolio companies in a bank. We monitor the NPL ratios very closely. We don't see an alarming rate at all. But, you know, this is like, you know, I think overall the private sector of Turkey survived much better than I thought 3 years ago from this cycle. But, you know, the thing is not over. You know, this kind of inflationary environment, as I said, ends with a recession or a very high cost of capital eras. Then we will see, you know, who will survive then. But so far, so good. In terms of SDGs, I think private equity managers play a very key role in emerging markets, including Turkey, because if you think about the stock market in a lot of emerging markets, including Turkey, it's not very deep. It's, you know, that in Turkish stock market is 350 companies. In many markets, it's a couple of, you know, handful companies you can invest. You know, affecting companies through public markets in terms of SDG from a DFI perspective is very tough. From that perspective, a lot of DFIs can affect these companies to basically act in a way, but then that's a very limited scope. You know, the PE managers like us, you know, when we invest and when our DFIs are investors, the standards we impose onto the companies we invest actually can help to realize this, you know, the SDGs much more effective than you know, the debt instrument or like a public instrument can do. We see the effect of this significantly in our companies, and I think within now all the sustainability reportings in our portfolio companies are. And the companies are also knows what to expect. It's very different than 5 years ago. The company sees this as a burden. They don't see this as a burden now. They see their, you know, one of the daily activities. So overall, I think private equity managers play a very key role in, you know, realizing this SDGs. The thing is, like in Turkey, this, you know, the PE industry currently there is a handful of GPs left. And I'm sure it's the same in many countries you operate. This industry needs to be deepened to have a more effect in terms of more number of managers and also, I think, the total, the capital they can allocate.
Okay. Thank you, Erman. Very interesting insights. Just to sum up quickly, although Turkey got impacted with these market disruptions, actually somehow it ended up benefiting as well. And last year performance was actually good, as you have highlighted, in terms of stock markets and also improvement of real estate sector performance. You anticipate that the result of the election is likely to impact the market, and you expect to have more orthodox policy to stabilize the economy. Also, an orientation towards more an open economy and diversification. Also, in terms of role of a private equity manager, you have highlighted proactiveness as key and being agile to stay ahead of the game and be able to intervene on a timely basis to monitor the portfolio and benefit from these market disruption. And you have given certain examples of certain portfolio companies. Also, you highlighted a few important things, basically the quality of the management of these underlying companies, as well as the access to data and access in a timely manner, basically for data to identify the actions or take the right actions in a timely manner. This also lead us to having really a very close monitoring of the portfolio companies. You anticipate as well that market disruption is not over yet. I mean, although private sector operators are still more or less afloat, but there is still a long journey, and one has to be closer to their portfolios. In terms of ESG, you confirmed basically what Nabil has explained in detail earlier, and it seems like most of PE managers today, they have ESG and impact embedded in their management strategy. And also the portfolio companies are more familiar basically, and they see this more as an opportunity rather than a burden to provide more data and so on and so forth, which is good news. So this really lead us to the conclusion of the interventions, and maybe we will give the opportunity to the colleagues to flash the questions. Yes, so just maybe a few questions, and then I will maybe give the floor to the panelists to address whichever they feel they have something to contribute. First one is, how can an individual project be funded by your institution, especially someone who wants to start up a diversified petty agribusiness? So I guess this is directed to the private equity managers, what type of whether they do this type of investment, and also maybe somehow to IDB, maybe if the colleagues, they can elaborate on this. How do you rate the Fed's handling of the current crisis, and what are your expectations of the interest rate cycle? When do you expect the Fed to start cutting rates? Perhaps this, David, if you want to have. Then the third question, how do you see the situation in Egypt progressing, and what will happen to the proposed asset sale program by the state? Are PE funds still able to raise funds for investment in Egypt? Are asset owners convinced of strategy to invest in sectors that are export-oriented? Maybe this is more for Nabil, given that you are operating as well in Egypt. The fourth question is, how can portfolios benefit from rising volatility? I think this is maybe for David and Boalam, if you want to elaborate on this. So go ahead, feel free to intervene.
Maybe Hadi, just on the last question, as I mentioned in my intervention that, and also David touched it, we live in a world of volatility. We cannot, and basically there's a difference between risk and volatility. And when we talk about volatility, there's not only a downside for it. What I mentioned, like we went through a 12 bull market in equity, 12 bear market. What does it mean? Also, there's another thing that we need to see through the empirical evidence. Those who stayed invested, despite the volatility and going through the crisis, are the one who recovered the most and benefited from the upside. And those who did not invest for whatever reason, because they are conservative or are risk averse and stayed more what they call not risky asset classes, they did not catch up the upside. And in the same time, they were not necessarily immune from the downside. 2022, the first half, all the asset classes did not perform, and there was this statement, nowhere to hide, basically. And that's why it's important to have a very diversified portfolio, and then when you invest, you mitigate volatility, and at different levels. Of course, diversification is the first level that can basically go through this, and then there is tactical, and then working with the right fund managers and having, whether it is passive or active management, basically make sure that the volatility is within the risk tolerance, and at the same time trying to stay invested and make sure that you are going according to your strategy, because the noise will be always in the market. And the noise shouldn't really distract you from your focus, from your objectives. And of course, all of this need to be grounded on processes, team, performance, all of that.
Thank you, Balam. David, Shahir?
Just maybe to touch base on the first question, Hadi, before giving the floor to David. So actually, on private assets perspective, there are actually the GPs are intervening in various phases of the life cycle of the companies. So I think our panelists are more on the growth side, or for startups, actually there are some more specialized specialized VC funds that can assist on such investments. So that's just wanted to address that. Thank you very much.
Thank you. Yes. So basically, what you are answering the person that IDB is not investing in startup directly, and that there are some venture capital funds that usually invest in this type of transactions. Thank you, Shahir. Yes, David, you want to?
Yes, maybe first just to follow up on Balam's comments on the impact of volatility, and I really like the idea of seeing that as an opportunity, as well as seeing it as a risk. And so, people often look at volatility as being a risk in of itself, but actually, there are a number of strategies that we can employ where actually volatility can be seen as an opportunity, and whether that's being dynamic with the management of the portfolio and presenting those opportunities to rotate asset classes, or if it's within the individual security selection. You need dispersion of returns from different securities, whether they're publicly quoted securities or privately owned securities. You need that difference in returns and return expectations to allow for some of that return generation through active management. So we often see periods of heightened volatility, while we're very mindful of how to diversify, also present opportunity to generate returns. I think the other one to maybe touch on was the second question. I think it was around the path of the Fed's policy, and have they done well, and how do we expect that to evolve? And I think, part of have they done that well is recognizing that there is a lag to the outcomes of the policy decisions. So I don't want to entirely opt out of answering it by saying we need to wait and see, but to some extent their biggest challenge is how do they manage the twin challenges of reining in inflation and controlling inflation while avoiding the deepest of recessions. And I think understanding how well they have navigated that, we may be sometime off being able to see that. That said, it's certainly the case that we're near at the end of this tightening cycle, and the period of easing rates will come as employment and wage growth begins to mitigate. So I do think that we can envisage the end to that tightening cycle, the introduction of some easing and less restrictive policy, and then the outcome and the true test of whether the Fed has done a good job will be once we see that, the impact of any recession, should it come in the next 18 or 24 months, alongside the path of inflation and consumer inflation.
Good. Thank you.
I think you want me to take, Hadi, the Egypt question?
Yes, Nabil, go ahead. I was about just to do that. Go ahead.
Sure. I guess the question was on the sale of public or state-owned companies or assets in Egypt. And as part of, I mean, just to give a bit of context, as part of the agreement between the IMF and Egypt, the most recent one, Egypt committed to a significant privatization program, and that has been fluttering over the last year. How it is progressing, it's difficult. It's frankly difficult to say because it is not. I mean, obviously, when you hear government representatives speaking, and if you speak to the central bank or to the sovereign wealth fund in Egypt, they are saying that they're trying to progress on selling the state-owned assets, but there are pressures against it. And one of the issues is that as the Egyptian pound devalues, the sale of assets becomes more difficult, right? Because what was worth 100 million last year in dollars is now worth 50 million just because the Egyptian pound has halved, and that is creating a significant drag on the process itself. But ultimately, I think they will need to progress on it because the Egypt as an economy and its foreign reserves, its foreign currency reserves, are dependent on the current program with the IMF being successful. In terms of the PE funds being able to raise money for Egypt, I believe this year is probably a challenging year for Egypt-specific funds. In our case, we're not. I mean, we cover all of Africa with a specific focus on North Africa, so it hasn't, from what we've seen, affected the fundraising prospects because of the fact that we invest in many companies in a number of countries, and because I mean, obviously, if you're raising funds today, you're investing over 10 years, investing over 5 years, and holding assets over 10 years, and it's probably fair to say, and it's a good bet to make that Egypt, whatever issues it's facing today, will be addressed in the next couple of years, and there will be interesting opportunities to invest in the next few years in Egypt.
Thank you. I think we have one question left, which is about the Fed. I think the crystal ball is not functioning there.
But I think David addressed part of it, yeah.
Yes. So maybe I will invite Irman also to open his camera so that the colleagues, I think they want to take a photo for the newsletter. So Rahaf, are you taking care of that?
Brother Heidi, it's gentlemen, I would really appreciate if you could give us a good big smile so that I can take a good photo of yours.
Yes.
On the count of 3, let's smile, please. So 1, 2, 3. Thank you, gentlemen.
Thank you.
Done. Thank you very much. Thanks very much to all the panelists. I know that it's a valuable time. Thanks for allocating the time for the webinar, and many thanks to the participants who stayed all the way with us, and to all the colleagues who supported with the technicalities and input to have this seminar as part of the program. And we will share the link to the respective panelists to share with their respective colleagues as well within their institution. And we look forward to other occasions to stay intellectually alive from time to time and share basically certain perspectives and certain views about the market. And we look forward to seeing you physically for those who are joining us physically for the annual meeting. Thank you.
Thank you, Hadi. Thank you, everybody. Thank you. It's been a pleasure.
Thank you.
Bye.
With pleasure. Take care.